Hey guys, this is Rene. Welcome back for another video on this channel. And today I want to introduce you to a new strategy that I created in the last few weeks, and it is my go long strategy. It is probably the most basic, the simplest strategy that you will ever see, but theoretically or historically it should have worked. So before I start introducing you to this strategy is also a part of the free expert advisors that you can use if you use my partner broker. You can read more about this on my webpage. You will find the link below this video, and you will find the Go Long Expert Advisor here for direct download. But let's talk about the strategy now. So what was my idea? Here we can see the chart, and let me make this a little bit bigger, of the US 30, which is the Dow Jones, the industrial average index of the United States. And as you can see, this one has quite a nice performance. Even if we would not apply any specific strategy, we could just buy here or pretty much at any point and be profitable in the long run, right? So just by buying this index, we are more profitable, or we generate more profits than approximately 90% of all traders. So my basic idea was, why can't we just follow this index to make profits nearly guaranteed if there is no really big change in how economics work and in how the world turns around. But this, of course, does not work that easily, because if we have a look at the US 30 and if we go to the symbol specifications for CFD trading, of course we have costs, and there are two very important parts that build up the cost pretty much when you trade CFD. The first one is what you can see in the symbol specifications. It's the swap. So whenever I would hold one contract of this US 30 overnight, I would pay 7.65 euro or US dollar in this case per contract, which means that if I hold one contract for, let's say, 200 trading days, or in fact, if we also hold over the weekend, we have like 300x days that we would hold this position. And it's a really simple calculation that you can do here. Let's say roughly 300. In fact, it's even more. But if we multiply this with the amount that we pay for one contract every single day, we would pay 2,300 US dollar. So for example, let's multiply this with the whole period that we see here, or let's say 10 years, we would pay 22,000 US dollar. So as you can see, if we trade one contract, the swap will eat all of our profits. So all of our profits are gone just because of the swap. And I also wrote the program and tested this, and it is in fact not possible because of the swap. And I know the swap changes from day to day or from week to week. It's based on the interest rates, I think. But in general, we can say buying and holding with CFD products is not an option. So what I thought is, since this swap is greater than the spread that we have, what if we just buy at the beginning of every single day and then sell in the evening of every single day? So we still kind of have the performance, but we do not pay the swap. The only thing that we pay is the spread. And if you find a very cheap broker that has a low spread, like for example IC Markets or IC Trading, here we have a spread in the morning hours of 120 points, which is 1.2 index points of the US 30 right now. Then in the European trading hours, it goes down to 1 index point, or 100 MetaTrader points. And in the main US trading hours, it is as small as 0.5 index points for the US 30. So my next idea was to write an expert advisor that does exactly this. And this was the birth pretty much of my Go Long Expert Advisor. As you can see here, if we have a look at the inputs, it's really super simple. We can say what our base money is. This is my account value that I want to simulate this on, for example, 50K. You can choose whatever you want. And then yeah, we have risk settings, we have TP and SL settings, but I will not talk about this because I do not use a TP and I do not use a stop loss. Normally, I always use a stop loss, but for this specific program, I do not feel the need to use a stop loss. And I will explain exactly why. Because here I calculate the position size, so I risk exactly 100% of my account for every single trade. But this is based on the 50K, which means, let's say currently the US 30 is at, let's say, 40,000 index points. And one index point is one US dollar or euro or whatever. Then what we do is we divide the 50,000 by the 40,000 here, which means that the position opened would be 1.25 or 1.3 whatever lots for this trade, which means that if the US 30 would go down to 0 in one single day, I would lose the whole account. But as we know, this is kind of unrealistic. So this is why for this specific strategy, I do not have a bad feeling when I trade with 100% risk and no stop loss. Okay, that's for the risk settings. Of course, you can play around with this. Like, everything is possible. You could choose a TP, you could choose a stop loss, you could go up or down with the risk. Completely up to the trader. I don't care what you do as long as you are responsible for your own financial decisions and as long as you do not risk too much. Make sure that when you trade, you only risk money that you could potentially lose completely. So then I said that I want to start trading at 1 o'clock in the morning and 5 minutes after this time, because if we can see here in the specifications again, we can trade only after 1 o'clock in the morning. So we cannot trade directly at midnight, for example, but we can start trading at 1 o'clock. Then I hold this position and I close it in the evening. Here I use 10 p.m. or 10:50 p.m. because the data that I get from the tick data suite, it usually ends at 23 o'clock, but this was close enough for me to do this backtest. So these are my settings, and now I will show you this in the visual mode, how it looks. I will quickly go over this because it's really simple, so I think I do not have to explain too much here because there's not really too much to explain. So what we can see here, as you can see here on the first trading day in this year, which is my testing period, at 1 o'clock in the morning or 5 minutes after 1 o'clock in the morning, we get this buy position. And as you can see, the volume here is calculated exactly as I said before. Since I trade a 50K account and I risk 100% without a stop loss, we open 1.45 lots at an index price of 37,000 something. It's just the calculation that I explained before. And then I can fast forward a bit here until the day is nearly over, and then we would see this position is closed, and at the next day we open another position. Super simple. The only purpose of this program is pretty much to save the spread, because the spread is more expensive than the spread. And here, of course, we lose some of the profits because we do not trade in this in these minutes here. But of course, sometimes you will lose a bit, sometimes you will gain a bit, so to say, because the market will open lower at the next day. Like, let me fast forward here a bit. Yeah, as you can see here we made a profit, like theoretically of some points because we bought a little bit lower. So I think this is like, it comes really close to just trading the index. So this was my idea. So I think it's, yeah, as you can see here, sometimes you get a really better entry. So yeah, just to explain this program. And as you can see here, we make profits or losses on the trades, but we do not pay the swap. So what happens if I just trade this for one whole year? Every single year, starting from, let's say, 2013. So for the last 10 years, I want to simulate this to see if we can get a similar performance to what we can see here. Of course, it's not completely comparable because the normal index uses compound interest pretty much, or it always uses the current equity or the current index price, while here we base everything always on the 50K. But this is what I will test now from 2013 up to 2024. So let me start this in the non-visual mode. Inputs are still the same. So we start from 1:05 a.m. and we end trading at the end of the day. And this is the graph that is generated by this strategy in the last 10 years. Okay, so here the test is over, and if we just compare the performance here of the strategy and compare it to the development of the price of the US index, we can see it is really similar. But especially the sideways periods, of course, drag the performance of the expert advisor down because we just pay the spread. And normally the index does not, or when you normally buy a ETF, for example, you do not have to pay the spread. So I was asking myself, what can we do to improve this? And there were two things that I came up with. One idea was to have less trades, and the second idea was to check if I can reduce the spread. And the second one is what I want to talk about first, because let me show you again the test, the visual test that I showed to you before. Because the test, the long-term test that I just made here, which generated this graph, was on the normal Dukas copy data that I get from the tick data suite, which is kind of high quality. But let me show you the visual test again, and then you will see what I want to talk about here. So when I do this visual test again, and we can see that here in the morning, let me fast forward to the next day here. So what we can see here is in the upper left corner of the chart, I made a comment in the chart so we can always see the current spread. And here you can see right now, wait, let me remove this thing here. So here we can see right now the spread is 500 or close to 550 points in the morning for this Dukas copy data. And this is just not realistic if you trade with a cheap broker, because it makes no sense to trade this strategy with a broker that gives you a spread of, let's say, 500 points in the morning, or like 400 points, or yeah, something like this. And you can see for the Dukas copy data, the spread in the morning is usually really high. But with IC trading, this is usually not the case, at least not in the last months where I observed this, because they have really competitive spreads for the US index, for example, or for most indices. Not for all of them. I also tested with the S&P 500, and here it doesn't really work because the spread is too high. But yeah, so what I did is I took the Dukas copy data for the US 30 and I modified the data, because for custom symbols you can modify the data. So what I did is I made the spread always 120 points, because this is usually the spread that I should have with IC trading here. IC markets, IC trading, kind of the same here in the morning. So if we do another visualized test here, I can show you how much of a difference this makes. And then we will do another long-term backtest. So here you can see now the spread is a lot smaller, and you can see it in the upper left corner. It is fixed at 120 points. And again, this is, of course, again, not 100% realistic, because I know that later during the day, the spread will become smaller, but this should not have an impact on my specific strategy, because I always open in the beginning of the day when the spread is at 120 points or 1.2 index points. And this is what I always try to talk about on the channel. Also, you have to try to get the most realistic backtesting experience, or most realistic backtesting setup. So if I go down with my spread to 120 points, this is a lot more realistic. I could go to 130 to leave some room for slippage and stuff, but for this specific strategy also I do not expect too much slippage, because usually in the morning at 1:05 a.m. there is not too much movement in the market, so the execution should be kind of smooth and there should not be a lot of slippage at all. So you can see this is the adjustment that I made to my testing setup. So if we now do another long-term backtest starting at 2013, exact same settings, everything's the same. The only difference is that now the spread is at 120 points compared to the like 300 to 400 points on average that we had before with the Dukas copy original data. So let me start this test now with the 120 MetaTrader points for the spread, or 1.2 index points with which it is for the US 30, and then let's see how this test turns out, and let's see if this test can now be better. So the next test here is finished, and you can see this time it has a better performance, I would say. And this, of course, pretty obvious to the reduced spread. So as you can see here, now the performance looks, or the performance of the strategy looks kinda like the graph of the index price. Of course, the index kinda tripled in this period, while the expert advisor was not completely doubling the money. But this is, of course, because like it's just different. As I said, with the compound interest and everything that the index kind of has and the expert advisor doesn't have. Also, the expert advisor has overall had overall smaller drawdowns. So there are some differences. But the main point is what I want to say at this point. You cannot trade a leveraged product like a CFD, which has a lot higher costs, of course, compared to a index, which has no cost literally because it's an index, and you cannot expect the same result, because for the leverage product you will always have more costs because it is a leverage product and you do not have to bind all your money. So the main benefit of trading leverage products is leverage, of course. So you could trade this specific strategy, for example, the go long strategy, exactly like this. You could have traded it exactly like this in the last 10 years, or you could have decided to go more risk or less risk or whatever. And the big plus is you could have traded 10 other strategies in this account. You could have also traded the range breakout EA or the go long in 10 other markets, or the range breakout EA in 10 different markets, all with the same, let's say, 50K in the account. Compared to if you invest 50K in one index ETF, all of the money is bound in this index ETF. So this is where the power of leverage trading with Forex and CFD, for example, where the power lies. And yeah, this is, for example, why I would still use this go long strategy in my personal portfolio. Also, in the end, let me show you one more thing. Yeah, at this point, of course, you can also use this in the German index, in the US tech index, etc., etc. Just do your own testing, as you can do with a free expert advisor from the website. If you decide to use my broker, and yeah, I would appreciate if you like this setup. But if you don't, it's totally fine. Not every broker is suitable for everyone. Little disclaimer at this point. But what I still wanted to show you is I put one more input here, because I said the second thing that you can do to improve the performance here is, or might be, to have less trades. So another thing that I tested is, what if we always only trade if there's a new high at one specific day? Because as we know, sometimes there are days like this. Like this was when COVID really hit, and we can see there were some days that were just negative. So the whole day was just negative, and this created a really, really bad day, and it would have been a lot better to just not trade these days. Also, there are many bad days that you do not want to trade. So what I added here as an option is the is-wait new high input. So this means if this is true, we only trade if we make a new high on this day. With this specific setting, it doesn't really make sense to start the trade already in the beginning of the day, because at the beginning of the day, there's a pretty high chance that we will see a new high. But if we start, for example, at 9 o'clock in the morning or some minutes after 9, and then we use this is-wait new high feature, let me show you this in the visual mode, what happens, and then we will have another and the last long-term backtest, because you can see this will also have another huge impact on the outcome of this specific strategy. So what we can see here is on this day, for example, we do not open the position exactly at 9:05 a.m., but we open the position when we make a new high on this specific day, and then the rest is pretty much the same, and we just hold the position until the end of the day. But for example, on this specific day, we can see here, like this day opened somewhere here, we made some highs, and then the market dropped. So until this point, until the end of the day, we did not see higher highs. So on this day, we just do not trade, which means that on this day, we saved the spread and we saved the EA from having a negative trade. And so on some days, you will save yourself from some losses. On other days, it will cost you some profits. But let's have a look at how this turns out in the long run. And this is very, very interesting. So let me do another speedy backtest here, starting from the beginning of 2013 with the same data. I mean, actually, I could go down here to the 100 points spread, or to one index point spread, because after 9 o'clock in the morning, when the European markets open, the spread goes down to 1 index point for US 30 for IC trading and IC markets. And now let me do this test with the is-wait new high option set to true and starting trading from 9 a.m. in the morning pretty much. So another long-term backtest here, we see the graph. Okay, so now also this test is over, and as we can see here, if we have a look at the long-term Dow Jones performance in the upper window here, we can see, especially with a long sideways period, now the latest settings here struggle a bit, but also we have one thing that these settings made a lot better than the settings before, because as I showed you here, these very, very bad days during the COVID, they had literally no impact on this strategy where we use the setting where we only trade new highs during the day. So you can see all of these settings have their pros and cons, and it's completely up to you or to everyone, trade the settings that he or she likes most. And yeah, this is just to show you how you can use such a simple strategy to benefit from long-lasting long trends, pretty much. And of course, there are always some adjustments that you can make. You can also apply some market timing if you like to only activate this program after there was a setback in index markets, for example, or you combine this with some moving average where you only trade this if the market is above the moving average. There are different options to use a program like this, but the idea itself is pretty simple, and I hope I was able to explain this. Like this strategy pretty much just goes long, as the name says, and I think this is very nice. Like, what I personally like about this strategy is that it is so logical, because it kind of really follows this concept of growing economies and growing price for indices, and this is something that is very logical to me. And if this is also logical to you, this might be a strategy that you want to use for yourself. And yeah, this is it for this video. Let me know what you think about this strategy, and I hope that you like it. See you next time. I'm out. Bye bye.